Hey y'all, it's your favorite trader Jazz, and today is going to be a quick whiteboard video that is going to explain the main terminology that you need to know before you start trading stock options. So the strike price is the price of the underlying stock in that options contract. And it usually always comes after a dollar sign. So for a SPY contract, you may see something along the lines of $485. SPY. That $485, that is the strike price. That is the price that you would pay if you were to fulfill that options contract. Now we trade contracts, we do not fulfill them. You just need to know the price that comes after the dollar sign is the strike price. The next thing that you need to know when trading stock options is expiration date. I'm running out of room, so I'm just gonna put expiration, but the expiration date is the date that you're gonna see on a contract. And let's say it has a date of 3/28, that is March 28th, that is when the contract expires. You need to know this because you cannot hold a contract past expiration date. You cannot sell it after expiration date. It is worthless. So you need to keep up with the expiration date, and you also need to know what expiration dates to buy. So most stocks expire every Friday. Some stocks expire every third Friday of the month, and some stocks expire every day. So you need to keep track of the expiration date of the contract that you bought. The next word that you need to know when it comes to trading stock options is premium. So I like to just go ahead and translate premium to the price you pay. The premium is the price that you pay for the option contract. So a lot of people get tripped up with the strike price and the premium price because of that dollar sign and all of that. That is not what you pay. The strike price, that has nothing to do with how much you pay. Well, it does, but I'm just trying to simplify things. It gets complicated But the premium price is going to be the cost of the contract, not the price of the stock. That's the difference between the strike price and the premium. So the premium price will look something like this. You'll see one or two numbers in front of a decimal place, and then you'll see a couple numbers after the decimal place. What that is the price per share. And because an options contract represents 100 shares of that stock, you have to multiply this by 100 or move the decimal over 2 places to the right. So for me, being a visual person, I just move it 2 decimal places to the right. Either way you go, you get the same answer. We wish it was just $2.56, but you have to multiply it by 100 or move it over 2 places to the right. And so the price that you would pay for an option contract with a premium of 2.56 is $256. That is the price that you are paying out of pocket to hold this option contract. The next term that would be helpful for you to know when it comes to trading stock options and trading in general is limit order. A limit order is an order that is placed on the market at a specific price. So there's market order and then there's limit order. Submitting a market order to the marketplace means that you are submitting an order, hey, I want to buy this contract, and you're telling your broker to just fill you at whatever price is available. So you have the bid and then you have the ask, and usually it'll try to get you in the middle there. But basically you're just saying, I want to get in as fast as possible. I want to get the first contract available. So you may actually not be getting it at the best price. You may have paid a couple dollars more than you should have by just doing a market order. A limit order is what I recommend people doing because then you're able to set the price that you want to buy the contract at. If it doesn't get to that price, the order does not go through. The next phrase you need to know is stop loss. Stop loss. Stop loss is a major component of risk management. A stop loss is a price that you tell your broker. Some brokers have percentages, a percentage or a price point that you tell your broker, hey, if this contract gets to this price, and the price that they're going off of is the premium price. If my contract gets to this price, cut my losses. All right, so you're taking a loss, but it is usually a smaller loss than you would have taken if you would have just let it run on, okay? So stop loss has to do with risk management, where to set your stop loss, All depends on your strategy that you use. I go into stop loss a lot in my course, especially when it comes to scalping and day trading. It's very important to practice and get comfortable with using a stop loss. Nobody likes to lose trades, but trust me, there's been so many times where I wish I did use a stop loss. The next terminology you need to know, I'm going to color code so it's easy. Long versus short, or bullish versus bearish. You could hear both of those, but you need to know what long means. You need to know what short means. Long means that you're getting a call on that stock because you are expecting that stock to keep going up in value. Short means that you are buying a put on that stock because you expect it to go down in value. So long, we're going up. Short, we're going down. The market is constantly going up. It has no ceiling. Think of long, it's long because it's indefinite. It has no ceiling. Short, you can only go down to zero. You can't go beyond that. So short, it has a bottom, but long has no ceiling. So if you're struggling with that, then think of it in that way. Next is a word that you hear a lot in the stock market industry, community. The news outlets refers to this word a lot. And that is point. So you may hear, oh, the Dow is down 50 points. Oh, the NASDAQ is down 100 points. Point equals dollar. That's all. I really don't know why they call it point instead of dollars, but 1 point is $1. That's all that means. So if you hear in the news, the NASDAQ has dropped 200 points, that means the NASDAQ is down $200. And last but not least, we cannot forget about the Greeks. Now, I'm not gonna lie to you. The Greeks are the most complicated part of options trading. But if you can learn the Greeks, you can not only learn how to use it to your advantage when it comes to profit making, but you can also know what to avoid when it comes to buying your contract. But the Greeks are basically the mathematical variables that go into pricing the contract, and it has to do with how the contract is moving in price as it stays open until it expires. So there's actually 5 Greeks, but only 4 that you're really going to hear. And that's delta, gamma, theta, and vega. Delta is semi-important. Gamma's, vega is so-so. And then the 5th one is rho. We kind of forgot about rho, like a 5th cousin. We don't really care too much about rho. Theta though. Okay, theta, she gonna get you every time. Theta is not one to be played with. Theta represents time decay. So, remember how we were talking about expiration date? Well, the closer you get to expiration date, the quicker your contract decreases in value. So let's say that your stock is just doing nothing, right? So you would think that the contract price would stay the same. If the stock is doing nothing, it's staying stable. Theta makes it so that even if the stock is not doing anything major, it's not going up, it's not going down, it's just stable, your contract is actually going down in price. And that's because theta representing time decay. That means that every single day, your contract is automatically getting 50 cents knocked off of it, 20 cents knocked off of it, 15 cents knocked off of it, and it's getting knocked off of the premium price. So it is important to look at your theta because you can just hold it for a day and the theta can eat you up. So Greeks are important to know just overall, but theta is going to be the one Greek that you may want to look into deeper and really get a better understanding of how theta works. And I do have an entire section on the Greeks in my Options University course. So there you have it, folks. Those are the terms that I think you need to know to get started with options trading. Of course, there's a ton of terms out there, but I hope that got you started on the right path and maybe answer some questions that you may have had when it comes to some things you have been hearing but didn't have a chance to look into yet. If this video gave you any clarity, then give it a thumbs up. Subscribe to my channel if you want more videos like this 3 times a week, and I will see you guys in my next video. Bye.